In the world of finance, a price is a signal. It tells a story about supply, demand, fear, and greed. In London and New York, the global price of silver is set by the trading of futures contracts and complex financial instruments. For years, this system has presented a certain number on screens around the world. That number represents the spot price. But if one looks to the east, to the markets of Shanghai, a different story is being told. Here, for physical silver, you can hold in your hand, the price being paid can be dramatically higher. Reports consistently indicate premiums reaching a stunning benchmark, the equivalent of $100 per ounce. This is not a typo or a fleeting spike, it is a persistent reality. This price differential is the first and most glaring clue in a much larger, quieter movement of wealth. It is the financial echo of a physical truth. Vaults in the West are being steadily emptied to feed demand in the East. To understand this, one must follow the metal itself, not just the numbers on a screen. Major financial centers like London and New York are not just trading hubs, they are storage hubs. They operate vast, secure vaulting networks that hold silver bars on behalf of banks, funds, and nations. These are the reservoirs of physical metal that back the immense paper market of futures and ETFs. For years, the levels in these reservoirs were stable or growing. The trend is now decisively reversed. Data from these vaults shows a consistent multi-year pattern of withdrawal. Hundreds of millions of ounces have departed. The bars are not vanishing, they are traveling. They are loaded onto planes and ships and transported to Switzerland for refining and then on to their final destinations in Asia. The evidence is empirical and difficult to ignore. Take the London Bullion Market Association, the heart of the global wholesale market. Its monthly reports have shown a sustained drop in total silver holdings. Similarly, the COMEX exchange in New York, where silver futures are traded, publishes weekly data on its warehouse stocks, the category known as registered. Silver, the portion specifically available to back and deliver against futures contracts, has seen periods of steep decline. This is the metal that matters most for the integrity of the pricing system. When investors in Western exchange-traded funds decide to sell, those funds must sell metal to raise cash. The units of these popular ETFs are often directly backed by physical bars stored in London. When these funds see massive outflows as they have, those bars are physically removed from the vaults to be sold. The buying counterparty in these transactions is increasingly an entity whose ultimate destination is the East. This movement creates a powerful and revealing arbitrage. Arbitrage is the practice of buying an asset in one market where it is cheap and simultaneously selling it in another market where it is expensive, capturing the risk-free difference. The $100 price in China versus the lower spot price in the West represents the largest arbitrage opportunity in the silver market in modern history. This gap is not closed quickly by traders because moving physical metal across the world is slow, expensive, and logistically complex. It requires shipping, insurance, and reassaying. The very existence of this wide and persistent premium is proof that the localized demand in China is so strong it cannot be met by local supply or by quick imports. It must draw from the deep storage of the West. Therefore, the narrative constructed from this evidence is clear and linear. A powerful and sustained demand emerges in China, driven by factors that will be explored later. This demand pushes the local price for physical silver far above the global paper benchmark. This high price creates a powerful economic signal. It becomes profitable to source silver from anywhere in the world where it can be bought at the lower paper price and shipped to China. The largest pools of available liquid silver are in the vaults of the Western financial system. The metal begins to move, bar by bar, shipment by shipment. The tangible wealth stored in those vaults migrates eastward. The $100 price is not the cause, it is the symptom. It is the market's loud signal that a fundamental reallocation of a strategic asset is underway. The critical question for any investor or business leader is whether this represents a temporary trade or the early stages of a permanent and transformative shift in the global map of tangible wealth. The movement of silver from west to east is not a random event. It is the result of a powerful and deliberate force. To understand this force, one must look beyond simple economics and into the deep currents of history, culture, and state strategy. The Western analyst often makes a critical error. He views the world through a single lens, assuming all markets. And all participants operate on the same principles of short-term profit and quarterly reports. The demand in China operates on a different frequency entirely. It is a fusion of ancient memory, modern policy, and practical necessity. This is not mere buying. It is accumulation with a purpose. First, one must consider the historical consciousness. For centuries, silver was not just a metal in China. It was the foundation of the monetary system. While the West moved on to pure paper currency and complex banking, the cultural memory of silver as real, tangible wealth never fully faded. It is embedded in language, in tradition, and in a generational understanding that some forms of wealth are more permanent than governments or economic systems. This creates a natural cultural affinity for precious metals, that is absent in Western societies, where financial assets like stocks and bonds are the default. When economic uncertainty rises, the Chinese saver's instinct is not necessarily to buy a mutual fund. It is often to convert paper yuan into something physical and immutable. This cultural bedrock provides a constant underlying demand that does not fluctuate with the daily news cycle. Then there is the structure of the modern Chinese financial system itself, which channels this cultural inclination into action. The state maintains strict control over capital flows. Citizens face limited options for moving wealth overseas. Domestically, they are presented with a set of choices that make silver strategically attractive. Bank deposit rates are often below the official rate of inflation, guaranteeing a slow loss of purchasing power. The property market, once a sure store of value, has entered a period of profound instability and volatility. The domestic stock market is famously speculative and risky. In this landscape of financial repression, where good options are scarce, physical silver represents a legally accessible, private, and historically proven escape hatch. It is a valve for preserving family wealth against erosion. This is not speculative demand, it is defensive demand, and it is immense. At the same time, acting on a parallel track are the strategic actions of the state and its affiliated entities. While much attention is paid to China's official purchases of gold, its policies actively enable and encourage the national accumulation of silver. State-controlled banks facilitate and finance the import of physical metal. There is strong analytical suspicion, supported by trade flow discrepancies, that the government itself maintains strategic stockpiles of silver, just as it does for other critical commodities like oil or rare earth elements. For a nation with a long-term strategic vision, securing control over key industrial inputs is a matter of economic security. Silver, essential for the very technologies of the future, like solar power and 5G networks, fits this category perfectly. The state's interest is not in day trading the price, but in securing the physical resource. This leads to the final inescapable driver, sheer industrial consumption. China is the world's workshop. It dominates the manufacturing of photovoltaic panels, electronics, and automotive components, all of which require silver. This industrial demand is not discretionary. A factory cannot decide to stop using silver in a circuit board because the price is high. It must purchase what it needs to fulfill contracts. This provides a hard, non-negotiable floor for demand within the country. It means that every ounce imported is consumed in one of two ways, either melted into a solar cell, representing permanent industrial offtake, or placed into a private safe, representing permanent financial offtake. In both cases, the metal is unlikely to ever return to the global market. Therefore, the Eastern mandate becomes clear. It is a triple-layered phenomenon: a cultural gravity pulling towards metal, a system of financial repression pushing citizens toward it, and a state-level strategy to secure it for both economic and industrial sovereignty. This combination creates a demand profile that is fundamentally different from the speculative, leverage-driven trading that characterizes Western paper markets. The West views silver as a trade. The East views it increasingly as a necessity. This mismatch in perception and time horizon is the engine that powers the emptying of Western vaults. It is not a fleeting trend, but a sustained reclamation, a rebalancing of tangible wealth back to a region that has both the historical memory to value it and the modern means to acquire it on a grand scale. What happens in a financial system when its foundational asset begins to disappear? The Western silver market now faces this precise, quiet crisis. It is built upon a critical assumption that the paper claims traded on exchanges and sold by banks are always, on demand, convertible into the physical metal they represent. The systematic movement of this metal from Western vaults to Asia is testing this assumption in real time. It is creating a quiet but profound vulnerability, not of price, but of function. This is not about a market crash. It is about the potential for a market failure, where the machinery of finance grinds against the reality of an empty shelf. The modern system is a layered architecture of promises. At the top are the futures contracts traded in New York or London. One contract promises the delivery of 5,000 ounces of silver. Below this are unallocated accounts offered by banks, where a customer owns a claim on a pool of metal, not a specific bar. Then there are the popular exchange-traded funds, whose shares are meant to be backed one for one by bars in a vault. This entire elegant structure relies on a relatively small liquid pool of deliverable metal, the registered stock, sitting in approved warehouses. As long as only a tiny fraction of paper claims ever ask for actual delivery, the system works smoothly. But the continuous export of physical bars is like slowly draining the reserve tank, while the number of tickets for fuel remains the same or even grows. The system's safety margin is shrinking. This creates a dangerous and growing divergence, the decoupling of the paper price from the physical reality. The price on the screen in New York is set by traders betting on future economic data, interest rates, and the flow of digital dollars. It is a financial price. Meanwhile, the actual physical bar in Shanghai or Zurich trades at a significant premium, reflecting the true cost of securing the tangible asset in a world where it is increasingly scarce in the West. This means the global benchmark price is becoming less relevant for anyone who actually needs the metal. It is a price in search of its underlying commodity. For a manufacturer in Germany needing silver for next month's production, the COMEX ticker is becoming a theoretical number. The real cost is the premium he must pay to pull a bar from a tight physical market. The benchmark is losing its authority because it no longer reliably represents the commodity it is supposed to price. For the entrepreneur and the corporate strategist, this bifurcation presents both a dire warning and a potential opportunity. The warning is one of supply chain fragility. Any business reliant on silver as an industrial input must now model scenarios where physical metal becomes unavailable at any price for short, disruptive periods, or where its cost becomes wildly disconnected from reported indices. This necessitates exploring material substitution, long-term physical stockpiling, or direct partnerships with mining operations. The opportunity, however, lies in servicing this new reality. The businesses that will thrive are those that provide the logistical, security, and verification infrastructure for this tangible wealth: specialized storage, secure transport, and assay services. The economy of physical possession is poised for growth. On a macro scale, this movement of silver is a single thread in a larger tapestry of deglobalization. It is part of a pattern where nations and regions seek to secure control over critical resources, from energy to semiconductors to food. The era of frictionless global commodity markets is receding. In its place is an era of strategic stockpiles, trade barriers, and regional pricing. The flow of silver is a leading indicator, a canary in the coal mine of globalized finance. What is happening to this monetary metal may soon be reflected in other, less visible markets. Therefore, the final assessment is this: the rally is not over, but it has changed address. The financial rally of charts and leveraged bets in the West may come and go with the whims of central banks. But the physical rally, the relentless strategic accumulation of tangible metal, is firmly entrenched in the East. The emptying of Western vaults is not a cyclical event, but a structural one. The when of a reckoning in the paper markets is uncertain. Its eventual occurrence, however, grows more likely with each shipment that leaves. The strategic imperative for the individual and the institution is no longer to bet on a price, but to secure a position outside a system whose foundations are slowly being shipped away. The new map of wealth values what you hold in your hand, not what a screen says you own. In this quiet transfer, the future of real value is being physically claimed, bar by bar, far from the trading floors where its ghost is still bought and sold.